think we'll get started now. So hi, everyone. I'm Austin Adams. I'm a researcher at Uniswap Labs. And I think we'll be starting up with Aviv with speculative denial of service attacks in Ethereum. Oh, my bad. I'm dumb. Joffrey Ramsire with augmented batch auction. Oh, no, that's the other one. Stablecoin devaluation risk. I am all befuddled. It took me so long to get here. So I'm sorry for being a little tired. So, perfect.
Yeah, so hello everyone, my name is Mi, and today is my pleasure to be here to present our paper, Stablecoin Devaluation Risk. So this is the paper which I co-author with Barry and Ganesh. Stablecoins are popular on-ramps and off-ramps for sales and purchases of various units in the digital universe. And stablecoins are actually widely utilized. So they are actually widely utilized as vehicles for transactions in popular cryptos such as Bitcoin. And stablecoin advocates suggest that they will gain even broader acceptance for use in financial and commercial transactions. Dominant stablecoin rely on centralized custodians of assets held as collateral or reserves, where these assets are held off-chains. The problem is that sometimes these assets, or a portion of them, are less liquid than the custodian's liabilities, thus the stablecoin itself. So this resembles a liquidity mismatch and run risk similar to banks. So it motivates us to address the following research question. Can stablecoin devaluation risk be priced using futures contracts? Our paper actually suggests that stablecoin devaluation risk can be priced using future contracts in pretty much the same ways that the risk that a national currency will be devalued in the foreign exchange market can be priced using the forward foreign exchange contracts. And our analysis of this relationship focuses on Tether, USDT. The reason is because USDT is the most actively traded stablecoin in the market, and it's also the only one with traded futures. So using the futures of USDT, we can construct a measure of stablecoin devaluation risk. And we define the measure of devaluation risk as the probability that there will be a speculative attack on the stablecoin pair. So here is the plot showing the USDT futures in the orange line and USDT spot prices in the blue line. So looking at this graph, we can see that USDT futures regularly trade at a discount to USDT spot prices. So before going into details of our paper, I'm just going to quickly go over our main findings at a very high level. So we construct a measure of devaluation risk, and then we find empirical findings with 5 empirical evidence suggesting that devaluation risk is determined by a number of factors, including Bitcoin volatility, network characteristics, and market sentiment. We then look at some case studies showing the contagion effects from Tether and Tether USD crashes and USDC debacking events. When we study the behavior of interest rate in the stablecoin markets, we find that interest rates in the stablecoin markets are actually disconnected from conventional money market rates and Fed announcements. We propose some reasons for this observation, such as market segmentation, lack of term structure, and cost of arbitrage. And finally, we also offer some suggestions for managing stablecoin risk, including real-time audits, regulatory licensing, and reserve requirements. So in terms of the stablecoin system and properties, stablecoins operate on the blockchain and are pegged to a reference asset, which can be fiat currency, commodities, or another cryptocurrency. So the total market cap of stablecoin reached almost $160 billion as of December 2021. And the stablecoin market is mainly dominated by coins such as USDT, BUSD, USDC, and TAI. So there are two main systems of collateral. The first one is national currency back, and the second one is cryptocurrency back. And national currency back is the one that is predominating. There are multiple uses of stablecoins. First of all, they serve as vehicle currencies for trading crypto assets, and this is generally due to a reduction in the intermediation cost by operating on the blockchain. Stablecoins are also used in DeFi application as well. So in particular, they are used as vehicle on Uniswap and DeFi lending protocols to earn high saving rates. There is also limited usage of stablecoin for remittance and cross-border payments. So in particular, residents in developing countries may use stablecoins to evade capital controls or high inflation. We identified that there are four main risks associated with stablecoins. So these risks include custodial, devaluation, systemic, and payment risk. So starting with the first one, custodial risk. So this risk arises when a centralized issuer who is responsible for the reserve management absconds with the funds. Devaluation risk is related to reserves or backings. So in particular, this risk occurs if the reserves or backing are less than 100% of the value of the issuance or less than perfectly liquid. And the next risk is the systemic risk. So stablecoins used in crypto markets can increase risk exposures of financial intermediaries. And the reason is because stablecoin issuers also hold other assets as well. So a run in stablecoin can potentially lead to systemic risk in the financial sector. For example, if the stablecoin issuers are forced to be engaged in fire sales of other assets. And finally, payment risk derives from the role of stablecoins as a medium of exchange. So if firms have receivables denominated in stablecoins, their flows are subject to payment risk. So this is the same as the foreign exchange market risk that firm has to face if they've got their liability denominated in the foreign currency and the local currency devaluates. So since May 2021, Tether started to provide a breakdown of its reserves. At that time, it was revealed that around 76% of Tether assets was backed by cash or cash equivalents. So we can see the recent report here in Q1 2023. Also, the figure has slightly improved, but we can see that only 85%, not 100% of Tether was backed by cash or cash equivalents. The remaining 15% were in less liquid assets, such as corporate bonds, precious metals, or Bitcoin. So if Tether is not backed by 100% liquid reserves, then it's subject to run risk problems. The reason is because if the demand to redeem Tether USDT exceeds the liquid reserves, Tether will either have to suspend redemption or sell other assets at a loss. So an example is Bitcoin, whose price is extremely volatile. So if there is a crash in the crypto market and the price of Bitcoin goes down, then it's going to decrease the value of Tether assets. And a decline in values of Tether assets relative to the tokens in circulation will trigger a run and mass redemptions. So here's our data collection process. So starting with spot and future. Yes.
How large is the collateral relative to the obligations of the kind of stable coin? Like, are they over collateralized?
You mean so in order for the peg to remain, it should be 100% backed by cash or cash equivalents, right? The liquid assets.
Yes, I'm asking whether their balance sheets exceeds the amount of coins they gave out.
The coins that they
That's my question.
Well, I mean, I would give it, I would say the bigger issue to me with Tether is whether the assets are really there because they're unaudited and they won't audit them. So to me, it's, you know, it could be like an FTX or another, you know, or a Madoff where you don't know that, you know, you have no proof that the assets are actually there.
Never mind. I will ask later.
Can we talk to you later? Yep, so we collect the data for spot and futures prices from Coin API. We define basis as the difference between futures and spot rate. And in terms of the proxy for market volatility risk, we use intraday volatility of Bitcoin. And regarding lending and borrowing rates for Tether, we collect them from Compound Protocol. And our proxy for money market rates is the 3-month USD OIS rate downloaded from Bloomberg. And in terms of network measures, we rely on Coinmetric data for Tether transactions and supply on Omni, ETH, and Tron blockchains. We are particularly interested in Tether in circulation, network distribution factor, and velocity. And we also construct a measure of sentiment for stablecoin futures using textual analysis. So what we do is to collect all of the newspaper articles mentioning the top stablecoins by market cap from Factiva. And then we implement both topic modeling approach to explore the topics of our corpus, which is the set of stablecoin related news articles in this case. Because in this paper, our interest is in futures, so we are gonna focus on the derivatives topic identified by BERT. So here's the word cloud summarizing the derivative topics. We can see that the most prominent words in this topic includes those such as contracts, futures, options, or products. And the second output generated from BERT is the set of articles with derivative contents. And now we are gonna focus completely on those articles with the derivative contents. We then rely on the Lagrange and McDonald dictionary to construct a measure of sentiment. So in particular, we define the sentiment measure as the number of negative words over the total number of words. So by construction, an increase in the sentiment index implies higher pessimism about stablecoin trading in the futures market. So here's the time series graph of our sentiment index. So to motivate our empirical findings, we start with a simple model of devaluation risk. So we denote ST as the spot price of Tether at time t, which is defined as the units of US dollar per 1 unit of USDT. So we then assume that the pair dynamics follows an AR1 process. So the mean reversion coefficient, there is a mean reversion coefficient rho is included in the AR1 process here. So the AR1 process allows for a direct mapping between the spot price today, ST, and the spot price at expiry, ST plus H. And then we iterate forward the AR1 process to obtain the pair price deviation at expiry as in equation 3. So we can see that the pair price deviation at expiry is equal to the current deviation discounted by the mean reversion coefficient rho and plus the discounted sum of Tether specific shocks. And then we got the spot rate at expiry follows equation 4. So with probability P, the pair is gonna collapse, which means that the spot rate is gonna be underlined S, with underlying S being smaller than 0. With probability 1 minus P, the pair still maintains, and the spot rate at expiry is equal to the exponential decay of pair price deviation at expiry, reflecting a series of shocks to USDT. Under the expectation hypothesis, the price of a future contract expiring at time t plus h is going to be equal to the expected spot rate at time t plus h. And then we can obtain the probability of default as in equation 5 here. So we can see that the devaluation risk or the implied default probability can be estimated based on the observable spot and futures rates. And this risk is actually decreasing in FT and increasing in HT. As H, the horizon, approaches infinity and underlying S is being equal to 0, the equation can be simplified to P equal 1 minus FT. So we then assume that underlying S is equal to 0, meaning that there is a full default as opposed to partial default. And then we follow the equation we just mentioned to construct the measure of devaluation risk. So here's the time series of the USDT default probability. We can see that there is significant time variation in the USDT default probability measure. And there are two local peaks of 200 basis points per annum, which correspond to two main events in the crypto market. So the first peak was during March 2020. That's when the crypto crash happened and the price of many cryptos, including Bitcoin, decreased by nearly 50% at that time. And the recent event was related to the Terra USD crash back in May 2022. And then we are interested in examining the determinants of the probability of a stable coin run on a range of factors. In order to do so, we regress the probability of default on a range of explanatory variables, including network measures, market volatility proxies, interest rate, and periods of net redemptions of stablecoin. Here are our main findings. So first of all, we find that there is a positive link between velocity and devaluation risk. Our interpretation of this result here is that investors are rebalancing the coins in their portfolio because they think that the coin is overvalued, or that they are panicking and seeking to redeem the coins at par on secondary exchanges. Then we also find that an increase in concentration is positively associated with devaluation risk. So this result supports the theoretical framework, suggesting that the risk in the stablecoin market arises if there exist more large holders of coin with market power, and hence the ability to trigger a run. By contrast, a more dispersed network of addresses is more resilient to run because in that market, each investor is marginal. We also find out that the devaluation risk is responsive to high market volatility proxied by Bitcoin volatility. The reason is that during periods with high market volatility, the devaluation risk is gonna decrease because due to the decrease in the confidence of investor regarding the role of stablecoins as the vehicles for transactions in cryptos. And then we find out that there is a positive link between lending rates and the devaluation risk, whereas there is no evidence suggesting a link between money market rates and the devaluation risk. And finally, in terms of our sentiment measure, we find that negative sentiment in news article is actually associated with increased devaluation risk. So now let's look at the first case study. So that's the Terra USD crash back in May 2022. So this event happened when Terra USD traded at a large discount from the peg. And this triggered a loss of confidence in the stablecoin market, which means that there were contagion effects observed in Tether as well. So this graph shows the dynamics of the price, the probability of default, and other characteristics of Tether surrounding the event. So starting with the first panel, panel A, we've got the USDT futures and USDT spot price. The red line is the event date. So we can see that on the event date, the spot price in the blue line dropped significantly. And the future price went down even more. And it took longer for the future price to go up to the pre-event level. In panel B is the basis. We define the basis as the difference between the spot price and the future price. So we can see that the basis dropped significantly after the event, and it took weeks for the basis to rebound. And the probability of default in the last panel here, we can see that it reached a peak of 200 basis points per year on the event date. In terms of other characteristics, we see that following the event date, the Tether experienced an increase in the concentration, volatility, and velocity, whereas the free float supply and the supply rate decreased. So here's the second case study, the USDC de-pegging in March 2023. So that's when the Silicon Valley banks went bankrupt. So Silicon Valley Bank was the one who hold cash reserves for USDC. And looking at this graph, the overall pattern is that all of the variables of USDC follow the same pattern as what we found with USDT in the previous case study. And finally, we wanted to explore the link between stablecoin interest rate and the money markets. So in order to do so, for the first three columns, we've got USDT spot price on the left-hand side. We regress the USDT spot on a range of FOMC announcement-related variables. We can see that none of the coefficient is significant here. So it suggests that there is no link between USDT spot price and FOMC announcement. On the fourth and the fifth column, we've got USDT supply rate and borrow rate on the left-hand side, respectively. And again, none of the coefficient is significant as well. So it means that there seems to be no connection between USDT supply and borrow rate with the FOMC announcement. In the last column, we replicate the findings with USDT net supply on the left-hand side. Here we can see that the interaction between FOMC announcement day and the USD interest rate is significant and is negative. This result makes sense because it means that on the days when FOMC announced an increase in USD interest rate, investors are gonna rebalance their portfolio and move to other assets as well. So it means that there will be a decrease in demand for USDT. So the supply has to decrease to maintain the peg.
Perfect. I think we're out of time. Sadly, might have to go to questions. That's all right. Perfect. Is there any questions?
Take a second to wrap up.
Yeah, sure.
Questions in the back.
Sorry, in the dark. Can't see you.
All right. Where did you get the borrow and lend data from?
We got it from Compound protocols. Yeah.
But they tend to be very volatile.
It's the hard life.
Yep. So we collected the raw data from them. So
I'll just come back here.
Oh, sorry.
Oh, sorry. No.
Yeah, no, I'm just because it is interesting that you can get that data, but just observing it anecdotally, the stablecoin borrow rates tend to be very volatile, and sometimes they vary differently between like Compound and even Aave. So that might be something to look at.
Yeah, sure. Yeah. Thanks a lot. Yeah, we'll look at the other data set as well.
Any other questions? I think there's a few questions back there. I don't know if that was sort of that was all of them. Sure. Do you want to maybe we have like 5 minutes, maybe a little wrap. You can do your little wrap up if you want.
Yeah, so I've got time, right? I've got 5 minutes.
Sure. A little, maybe 2 minutes.
2 minutes, okay. Yep, so I'm just gonna go through this result very quickly. So we offer some solutions for managing stablecoin risk from both private and government sector. So starting with the private sector, one possibility for minimizing devaluation risk is to have real-time audits by third-party proof of reserve systems. So third-party verification of stablecoin collateral at a block time frequency can provide further transparency on the stablecoin collateral value. And it also helps to mitigate the risk of the stablecoin issuer absconding with the funds by creating an early alert. Yep, and another suggestion is to have the proof of reserve system provided by Chainlink as well. So TrueUSD is one of the stablecoins that partner with Chainlink, so that Chainlink started to provide automated audits for TUSD to ensure full collateralization at all times. Yep, so in terms of the government policy, we suggest that some regulatory framework should be put into place to help mitigate the devaluation risk. So one example is that the stablecoin issuers should be subject to capital requirements, meaning that they need to have sufficiently high proportion of high liquidity assets as these reserves. Yep, so basically, here's the conclusion. So in this paper, our main result is that we construct a market-based measure of devaluation risk and the retail futures, and we find that the average of our index is around 60 basis points in annualized term. And then we know that the stablecoin adoption in cross-border transactions and financial applications could have implications for investors, regulators, and policymakers. So thank you very much for your attention.